AMC, and Nilesh Shah, MD, Kotak Mahindra AMC.
Hello. Oh yeah. Just remove the badge. It will hamper with the mic. Okay. Why? Because disclaimer is not written here. Okay. Hello and good evening and welcome to the first panel. We're walking the mutual funds journey from 40 trillion to 100 trillion. Now, Karunya obviously set the context of the panel, but I'll just add my 2 cents more. Most of us who've been in this industry for long, we've been told and we've listened to several people saying that, mutual funds is a nascent industry, the Indian mutual funds industry. For long, that word nascency was attached to the Indian mutual funds industry. But, today when the industry AUM is about 40 trillion, every month about 13,000 crore worth of money is coming through SIPs. You can't say that industry is nascent anymore. In 2017 and 2018, if you see, the AUM of mutual funds was about just 17% of the overall bank FDs. Today, it's about 26%. Yes, the gap is closed. It's not that close, but it's definitely closed down. And even if you compare the AUM of mutual funds as far as insurance is concerned, there has been a tremendous progress. So, we can't say now that mutual funds is a nascent industry anymore, which means that the journey from 40 trillion to 100 trillion is going to be challenging. It's going to be different. AMCs and fund houses will need to sort of alter the way they think to go ahead. Why? Because the markets are getting complicated. Products are also getting complicated. New kind of products are coming in the sense that, mutual funds today are getting competition not just from passive funds. They are also getting competition from AIFs, from small case, and from PMS. So how is the industry slated to walk this 40 trillion to 100 trillion? What are the new opportunities and what are the new challenges? That's what we're going to be discussing today. So Radhika, Nilesh, Navneet, and Neil, welcome to the panel. And Nilesh, let me start by asking you. We'll deep dive into specifics as we go along, but just to set the context, give me one big challenge, one big opportunity for the Indian mutual funds industry from 40 to 100 trillion.
The challenge is to add value to my customer. Like in last 30 years, we have added value. Next 30 years, I have to add value. If I don't add any value, I won't be here. That's my challenge. The opportunity is that I have reached today to about 4 crore investors. There are about 25 crore Indians having two-wheelers. And there are 140 crore Indians who has need for financial security. How do I go from 4 crore to first 30 crore and then to 140 crore? That's my opportunity. Mutual fund is the most transparent, most cost-effective financial security provider. I need to reach out to 140 crore Indians.
Okay, so basically to service, to give value to your customers is obviously going to be, you're saying that's going to be a big challenge because you've given some amount of value so far and you have to keep up with the pace in the next 5 years or 10 years or so, also as you reach 100 trillion. But, to be able to do so, Navneet, is it fair to say that, AMCs have to be sustainable? Profitability growth, because this is when we speak to so many AMCs, especially, of course, you guys are the big daddies of the world, so you've been around for like 2 decades or so, but, the newer size, the mid-size AMCs, the small-size AMCs, it takes a lot of patience to remain in this industry. So, profitable growth is important, but, so many passive funds are now being launched by mutual funds industry because one, regular rising popularity. Number two, SEBI has also set the categorization in order so that you can't launch more than one active scheme per category. So the only way for you all to grow is to launch more passive funds, more ETFs, more thematic funds as far as your products bouquet is concerned. So I'm just wondering, with low costs, products, how will AMCs be able to sustain profitable growth to be able to serve the customers better?
So for growth in our business, you need two things. Number one, the value system which is needed for success in this profession. So as you said, you are the big daddy today, but we were a small startup in 1999. We were the 26th AMC on that day. Our license number is 44. Over the years, I think it's a value system that has made us where we have reached. The second thing you need is the right economics for the business. And if you combine these two, I'm sure given the growth potential that Nilesh talked about, there is a lot of opportunity for all kinds of people. As long as you have the right value system, you think about the client first, you have the compliance and risk consciousness that Mr. Anand Baru alluded to quite a bit. I think you have the right kind of transparency, the highest standard of ethics, and always thinking about, am I adding the value to the client? And also not only focusing on the product alpha, but over a period of time for growth, we need the solutions alpha. How do you provide the right solution to the investor rather than just generating alpha on the product? But I'll just tell you about, just a point that Nilesh mentioned earlier about now we have reached 3.7 crore unique investors, 14 crore accounts. And you also mentioned that number 17% of bank deposits. So our industry was 10 lakh crores in March 14. We were 20 lakh crores in 2017. We were 30 lakh crores in 20, and we are 40 lakh crores today. It looks like a massive growth, but almost this entire growth is from equities. The equity AUM has grown from 2 lakh crores to 20 lakh crores, which is a combination of investors investing more, SIP AUM that has grown to now over 6-7 lakh crores, and also the mark-to-market gain. If you compare the banking industry, and I'll just make a point on what Mrs. Thorat mentioned about the institutional money. The bank deposits crossed 100 lakh crore number in September 2016. Bank deposits today are 170 lakh crores. When bank deposits were 100 lakh crores in September 16, the fixed income AUM of mutual fund industry was 10 lakh crores. We were 10% of bank deposits. Today, 170 lakh crores, and we are 13 lakh crores in the fixed income and in liquid. Even if you add a little bit of that GSEC index that has got added, but then you have to see the size of growth of the overall GSEC market. We are actually shrunk as a percentage of bank deposits. I repeat, we have actually shrunk as a percentage of bank deposit in terms of our growth over the last 5 years or so. There is tremendous potential there for us to grow there. Equities have done well, but as Nilesh bhai mentioned, we are still 3.7 crore people, so we have a long way to go. But it takes a lot of time for an industry to reach a certain stage, and going back to that economics of the business. So it took us almost 20 years of that hard work of SIPs and power of compounding over a long period, etc. The next 5,000 crores came in the next 2 years. But I think over the next several years, now we have reached 13,000 crores. Over the next several years, I think this is where our big focus would be. How do we get more and more investors who understand the long-term power of compounding, stay with us for the long term, and we, as an industry together, we focus on solution alpha, and at an individual AMC, all of us focus on the product alpha.
But Navneet, a lot of that growth which you said came in the last 2 decades also came because of product launches. You kind of launched so many funds across the different spectrum, which actually led to categorization. My limited point was that,
No. You know which is the largest fund in India? HDFC Balance Advantage Fund, close to 50,000 crores, is the oldest product, was also one of the oldest product in India. And same is the case with all the other products. I think large part of the money is coming into those products. The other day I was speaking at an event and they were asking about the innovation. I said the innovation is Mutual Fund Sahi Hai campaign. The innovation is in the communication. The product innovation is playing a very small role in for us to grow the market. In India, where large number of investors, I mean, if there's 170 lakh crores of bank deposits, to those investors, we just need to go and provide an instrument which can beat inflation, which can deliver better than the bank deposits. And how do you ensure that the investor understands that product?
Okay. Radhika?
And by the way, I mean, don't get me wrong. So product innovation has a role to play. There would be different kinds of investors. In last 3 or 4 years, international funds have grown to like from hardly anything to $7 billion, right? We hit the limit. There are investors who are looking at PMS. There are looking at alternative funds. There will be everything will grow given the size of the opportunity in India. But bulk of the growth for next several years, all of us are mainly focused on how do we get the next, I think, to to us out of 1.4 billion people that Nilesh bhai talked about. The total addressable market in the near term is maybe anywhere between 10 to 15 crore. I think the next 6 to 10 crore investors, bringing them through an SIP, simple product, I think is where our industry's efforts are directed at, and we'll continue to work hard at.
Active and passive funds both.
All put together. I think large number of investors are yet to meet the market. We focus a lot on beat the market. And as I said, that focus on solution alpha, the investor alpha is a lot more important than product alpha. We have to justify our fee. We have to deliver that alpha. For that, we have to do everything that is needed for that. But at the same time, the bigger need in the industry for all of us to work together is to get that investor. No. Also, again, I mean, slightly digressing about this whole cost of the active and passive. And when you compare the passive, you are comparing with the total return index, but you don't get the return, right? I mean, in an ETF, if you add all the other cost and the impact cost of buying and selling versus the transparency that you are getting in an actively managed fund with that fee, I think they will beat them hands down any day. I mean, the active will beat them hands down.
Yeah. Sreekanth, please come to the panel.
Maybe if I can, Mrs. Thorat mentioned about that institutional investors. Ma'am, I was managing the first liquid fund in India, and it took us several years of convincing corporates for us to reach 100 crore size. And today you mentioned about 21 lakh crore come from institutional, from individual investors, 19 lakh or whatever odd is from the institutional investors. A good part of that is also the EPFO and the pension fund money. Apart from that, corporate money is mostly in the liquid and the short-term money market. On the equity side, almost 90% of the money is from individual investors. On the contrary, globally, if you look at the asset management industry, large part of their AUM come from pension fund, insurance companies, banks, local government, large part of the institutional investors. In India, we have no access to most of this institutional money. Hardly any institutional money comes to the mutual fund industry. On the contrary, I would argue, given the scale that we have got, given the track record that we have got as an industry, given the intense regulation and the public scrutiny that we have, an intensely monitored and intensely audited industry that we are, and the talent that we have developed, this talent should be leveraged for us to manage a lot more money of other institutions where I think it could be, I think some of those resources may be suboptimal. And that will give us economy of scale for us to invest a lot more in going to the next 100, 200, 500, 500,000, maybe in my lifetime, to all the villages where we get the money from.
Okay. So let's move on. Radhika, one big opportunity or one big challenge, I would say, in front of the industry, and this is also when we talk with various industry players, is talent. Okay, we've seen fund managers like Prashant Jain, Naren or Harsha, been there for like 2 decades or so. Today, the competition has also gone up. We don't see fund managers sticking around with organizations for so long. Do you really think that we'll see the next Prashant Jain or the next Kenneth or the next Naren? And, how are you going to nurture the talent? Because there are new fund houses coming up. Costs are going down. You have to pay fund manager salaries. Of course, salaries are good, but what's the next 5 years, 10 years looking for from talent management?
Yeah, so before I answer that, Keza, I'm glad that you said mutual funds have a lot of competition, but for once you didn't include crypto. So one asset class, at least we put a nice lid on for the time being. Look, I think Navneet and to an extent Nilesh started their journey much earlier as brands, and they're backed by large financial institutions. But before I come to the talent question, what I would say is that the journey of building a profitable asset management company, if you are starting late, is not an easy one, and I don't want to mince words around that. In the last 5 years, I've seen our own trajectory go from about 40 crores of loss making to 30 crores profit making. But, it is a difficult one. Costs of compliance are going up, costs of talent are going up, and margins are going down. And yet, it can still be done. As far as talent is concerned, firstly, I think due respect to everyone and all the names that you've mentioned. But I think one thing that we have to realize, and this is something we are cognizant of when we build a business, is that talent is mobile. It will move to opportunities within mutual funds. It will move to opportunities outside in other asset management spaces like PMS and AIF, and it may exit the industry to go to fintech or RTA or anything. So I think we have to realize that talent is mobile, and I would argue that younger talent is even more impatient and more mobile, and all of us are seeing that. We live in the time of the great resignation. So I think one lesson for us as a fund house is that while we respect investment talent, and that's the core of what we are, we build ourselves in a very process-driven way. We just had a change of equity CIO last year, and it is a major change for any fund house. But we've managed to go through the change without any impact on performance or business. And I think that will be the kind of reality. So you ask the questions about succession planning, you ask the questions about process, and you build for the fact that talent will migrate. I think we also have to find ways, we've been very fortunate in the last 5 years, we've gone from 40 to 300 people, so it's a new team. And despite turmoil in the parent in 18-19, we haven't lost people. So I think talent is never just about compensation. Talent is about the opportunities you give them. Talent is about the growth you give them. So that, most mutual fund managers are very excited to be mutual fund managers. The opportunity to manage hard-earned public money and build a public track record is something that you can't
But the alpha generation is becoming difficult and difficult, more so especially in the large cap space. I mean, you yourself had told me that you had reduced your expense ratios for your large cap fund because, it's difficult to justify when the alpha is so small. And, when you're getting, opportunities elsewhere now in the industry, small cases are there, PMS is there. Now, so you've had instances of fund managers leaving AMCs and joining, starting their own PMSs. Where does that leave the mutual funds industry from a talent perspective?
I think with due respect to, and, many of us run PMS, AIF, small case and all the platforms, the opportunity to manage public money on a platform like mutual funds, where in a regulated format, you've built a public track record. And many of the names, by the way, you've said, Prashant Jain, etc., are household names because they are known by common people. That's something you can't buy in money. I doubt many small case managers have that kind of legacy. So I don't think you can take away from the opportunity. And this is what people tell us in interviews. For every person who's going to PMS and AIF, there are managers coming from insurance or PMS and AIF who want to have a career in the mutual fund industry. As far as alpha is concerned, I think Nilesh bhai put it well. There will be good managers, there will be managers who outperform benchmarks, there will be ones who don't. Those who add value to their organization and customers and to the benchmark will get paid well, and the others will not. There is no arbitrage in the market in that sense.
Okay.
Can I add something?
Yeah.
So the mutual fund industry's talent retention will depend upon a woman like Parul Shah, who's my wife, my better part, and also Navneet's wife. I get 100 rupees salary, 43 rupees taken away by government straight. So I'm left with 57 rupee. To secure my future, I give 10 rupee in NPS and 10 rupee in Provident Fund. Effectively, 37 rupee comes to my hand, of which SEBI takes away 20 rupee by skin in the game circular. And I give 17 rupee to Parul Shah. As long as she manages my house in 17 rupee, I can work in Kotak Mutual Fund.
Does she invest her money in Kotak Mutual Fund or other schemes?
The 17 rupees kaizad which is left, I am sure women have the power to save out of that.
That I agree.
Every woman is blessed to run the house with whatever money she will get. The second thing, sir, that will be for my kids, not for my wife. The second thing, and which is more critical, is the space given to us to go out and build mutual fund industry. There are days when I haven't attended PTA meeting of my kids because I was in building mutual fund industry. We could all do it because our better part was willing to back us up. As Radhika mentioned, all of us, if we work individually, will earn more than what our mutual funds are giving. We are working in this because it gives us respect. In my engagement period, ours was an arranged marriage. My wife was a professor. Wherever she used to go, she'll get respect from her students. I was always wondering कि एक दिन ऐसा आएगा कि अपने को भी respect मिले. It is thanks to mutual fund industry that we are getting that respect. This is the industry where I can make money, I can get respect. So as long as we have women like Parul Shah, I'm sure there will be talent in mutual fund industry.
Speaking,
The day we miss that, I don't know what will happen.
Nilesh, bhai, speaking of women, you know, I'm still supposed to be on maternity leave because the government rule is 6 months and my son is 5 months. I started working after 6 weeks because I love this industry and that's the respect it gives you.
Okay. Let's move on. Neil, you've been quiet for quite some time, so let's bring you in now. Neil, you know, your fund house, when you all had launched, I think, what, 9 years now, Parikh?
9.5.
9.5 years. You know, it has been an inspiration to a lot of small-sized and new fund houses because your fund house, I remember it was launched on, you know, the basis of certain principles, certain ideals that, you know, you will launch only one fund, you know, one fund. That one fund will do everything. And, you know, you will engage with distributors in a limited way. You will keep your costs down, etc. You know, those ideals your fund house was launched, and most of that you have retained it over a long period of time. So you are one of those niche fund houses. And there was a space and time for niche fund houses even in the Indian mutual funds industry all this while. I'm not saying that there is no space going forward, but that is what I wanted to ask you, that, you know, when you are pinning all your hopes on just one fund, and when things don't work the way you want to, like for example in this 1 year has been tough because, you know, your 26% you have been investing in international equities, so that's basically been affected because of the tech crash, and also because, you know, the RBI and SEBI has not yet revised the limits for international investing. So that approach, you know, the niche approach, you know, one fund, I will do everything in just one, will not launch a supermarket. Is that principle still valid when the industry goes from 40 trillion to 100 trillion? I mean, how much of a mind share or market share would you still retain?
Yeah, so we were asked the same question at 10 lakh crore when we launched, and we had 40 lakh crore, and I think we've done reasonably okay in this journey. So I think if there's conviction, what you're doing, if you are adding value to the investor, if you're building trust, and you're investing your own money in the schemes you are going to launch, you know, and one of the things we've said is that this is something that there's a fiduciary responsibility to it. So we do what's good in the investor's interest. So we will launch funds only if there's some simplification or differentiation we can do. If we can add value to the end investor, and if we are excited to put our own money in this fund. If I am not excited to put my own or my family's money, then I cannot go to someone else to say that put money in my fund. So as long as these three things are there, these three criteria are sorted, then we will launch funds. It's not like we will not launch funds, but it has to make sense to us, and it has to make sense to our investors for doing that. And I think you can be valuable, and mind you, we were profitable from year one, you know. So at 150 crore AUM, we were profitable. Today at 30,000 crores, we are way more profitable. So profitability has never been that much of an issue. I think if you run a lean organization, I mean, if you don't overspend on things that you're not supposed to overspend on, then you can be profitable and you can run this with very few schemes. So I don't think that's a challenge. I think 40 to 100 also, I think we will do what we are doing because I think we've got conviction in what we are trying to do.
Can fund houses in these days survive with just one or two schemes? You know, you have to also nurture talent, and you're pinning all your hopes on one scheme, you know, on one set of market conditions.
Yeah, so look, I think you cannot look at performance over a year or 6 months, and unfortunately that's what happens in the market, right? Everyone looks at past performance of 6 months, 1 year, but I think one of the challenges is to make sure that the investor has the proper mindset, the expectations are managed well, so you cannot, if we are talking right now about 6 months and 1 year you didn't do well, but we're talking about, and when we all talk about equity as a 5-year, 7-year product, so I think we should look at it through a 5-year, 7-year period. So I think a lot more education needs to be done, a lot more good communication needs to be done. And yeah, I think you can be profitable with a few schemes. I mean, yeah, if those schemes are 30,000 crores, then sure, you can be profitable.
Sreekanth, hi. We're glad that you can join the panel. Sreekanth has had a very busy day today because KFin has just headed for its IPO. So he was busy with all the road shows. But thank you so much for making it for our panel. Sreekanth, one aspect where an R&T such as yourself comes in is customer service, the kind of experience that you all give to investors after investors enter mutual funds. Now, performance and alpha generation is a headache that is shared by the rest of your panelists. But customer service, because when you are facing the customer directly, you're handling their records. One thing I can't oversee is that, where industry has expanded, number of players have gone up, number of investors have gone up. The number of R&Ts have basically gone down. Earlier, you had a few small competitors. I suppose even Templeton and UTI had their internal R&Ts, but even that is also now gone. So it's only the two of you all. It's a duopoly. Investors are going up. I think there are, 4 crore investors in mutual funds today. So realistically, two things I wanted to ask you. How many customers can a single RTA can realistically manage? And number two, do you think that the industry has now come at a stage where we need more RTAs for better customer experience?
Thanks, Kezad. I'll go back to probably Neil's answer in terms of, I guess, similar question could have been asked when we were 10 lakh crore or 5 lakh crore. I think, we, as registrars, seem to be able to manage the workload reasonably well. I think, not too distant past, this country has had close to 10 registrars, several of them multinationals, including Morgan Stanley, JP Morgan, Citi, Deutsche, Franklin Templeton, so on and so forth. I think the consolidation has happened largely on the back of, being able to, entity being able to provide superlative solutions at a cost profile which makes sense for the market. I've heard about alpha compression and hence, every penny counts. So does the registrar's cost at that point in time. In terms of what is that we are able to bring to the table is that an elevated levels of services baking into account a significant amount of regulation that has come into the play over the last 3 to 4 years, yet delivering at scale in terms of the number of investors. Right? I mean, today we manage close to, so as a registrar, we are not just in mutual funds, we're also in the secondary markets, right? Just so that our total scale of operations, including that of secondary market, is close to 22 crore folios on a unique investor base of close to 6 crores. So what you're really talking about is, it's a single entity and not even including the larger, RTA camps here. We ourselves are today able to manage 20 plus crore folios spread across 6 crore investors. So you already have a use case of an entity which is able to do it, which is pretty much the entire combined mutual fund space put together and probably 50% more of that. Do we need more registrars? I think it's always good to have more players. I think innovation is something that always gets the better of it, when you have more players to add.
And I'm also talking from the point of view of cost reduction also, because the cost that you all charge to the AMCs, some of them privately say that, the costs are a little high for every little value add that you give to the AMCs. Now, when you are headed for an IPO, you are supposed to be thinking about your shareholders' interest, your top line and bottom line also matters. So I'm really wondering, is it conflicting with, the relation that you will have with the industry going forward? Because your priorities now would need a little slight altering, no?
Okay, now several of the participants, delegates, and the co-panelists are my clients, so it's a tricky question to be answered. But let me put it this way, right, Kezad? I come from IT industry. I'm not from asset management background. You're all, for me, people whom I look up to and respect and try to learn as much as I could. What I've seen is our commercial model, if you read it, it's largely certain basis points on the assets under management, which effectively translates and mirrors the growth of my client. So my client grows, I grow. My client does not grow, I do not grow. So a time like COVID, for example, when the markets fell 50%, right? clearly our revenues did, but my cost does not come down. Right. So, we partner the growth of the client. I think it always happens that when a particular asset management company grows very fast, given that my basis points continues to remain, similar, there is a tendency to feel that, oh, well, I'm paying a lot. But the same does not count into account when the markets are subdued and not growing at all, right? And obviously we bear the brunt because our costs continue to expand. But let's put some facts into perspective here, right? Against the total expense ratio, the blended yield of a registrar is about 3 basis points today, right? That's the total blended yield across all asset classes across the industry at this point in time between both the registrars put together. I don't know if it is that material for the entire gamut of solutions and services we provide. A large asset management company, will require at least 500 to 600, maybe even 1,000 people to work, despite significant investments into technology. Technology today subsumes almost 40% of our costs, right? I mean, elevated service levels, things that used to take days, today gets done in seconds. So I'd like to believe that that much amount of wiggle room should be provided to a partner such as us, because it is through that mode that significant amount of innovation could be brought into the table and not just provide, bare bricks of solutions and services.
Okay, I'll let you go this time. So, anyways, thank you so much.
Can I make a tiny point?
Yes, please.
I'm one of Sreekanth's clients, so I'm going to upset him ahead of his IPO, but I'll take the liberty to do that. There is a lot of focus on the costs of asset management companies and us, and active and passive, and how much alpha and fees. I run a debt passive business. We are, fairly large in that business, let me say that. And my Nilesh bhai just talked about his salary and where it goes. Let me tell you where my expense ratio goes. I charge an expense ratio of 15 basis points in the direct plan. 1 point I give to Amphi for investor education. And 7 basis points I give to my RTAs, NSDL, custodians, index providers. That leaves me with, I think, 6 or 7 less basis points. I actually earn as an asset management company less than all the service providers. So I think that there needs to be, in fact, I keep joking that if I were to ever quit the industry, the business I would do is form a Digi RTA. So I really think more competition in this space is welcome, and a lot more focus. If you're going to focus on a passive industry, a lot more focus needs to come on the cost of operations for AMCs.
Point taken, point taken. Okay, so folks, we've completely run out of time because Nilesh and Navneet and also Kalpin from our next panel, they have a flight to catch. So thank you very much for a lively panel discussion. And I'm sorry that I can't take any questions, but we'll try and take questions in the next panel. But thank you very much.